Well, hello folks, this is ICT with the eighth and final installment in the Scout Sniper trading series. This episode is going to be called Escape and Evasion. Now what it's going to be doing essentially is providing you a summary and an overview of what it is specifically that you should have gleaned going through each individual installment. Now, it's not my aim to produce additional technical concepts in this episode. In fact, what I've done was I forced you to spend 6 months. If you do the calculations on your calendars, you'll see that we've spent 6 months from the initial installment to now this one being the last in the series to be released. Because what I did was I forced you to look at the concepts over a period of time. Okay, you have to have a sample set of looking at each individual component that was produced and released in modular form. Each episode had its individual premise in mind for you to study and utilize in your own exercise and training. So that way it allows the individual viewers the time that's necessary to adopt the understanding that each component requires. Once we understand all of the components collectively, okay, and intimately on each component, once that's understood, then it's very easy for someone that's a mentor or teacher to conceptualize it into a trading plan or a process of engaging the market. So I guess it's a long way around saying you needed to take the time to study each individual component, know it intimately, understand why it does what it's doing. Okay, and what am I referring to? Well, the time of day theory. Okay, what happens between 2 o'clock and 5 a.m. New York time, okay, during the London session? What do you typically see? What type of price actions usually characteristic of that time of day? The London close between 1500 and 1600 GMT. That time window typically, produces something else in terms of price action that's very generic and repeats itself over and over and over again. The New York Open, okay, 12 to 1400 GMT, okay. What happens during that time frame? Okay, on a daily basis. Doing that over a period of time builds an understanding, again, intimately, on what each individual component of each installment that we produced and shared with you. So by having that amount of time and that exercise oriented approach to learning, hopefully you've done that. If you haven't, obviously this episode will uh, more or less force you to go back through it again. Okay, and actually it's in my intentions really to make you go through that series one more time, and it's not for YouTube views or statistics, to try to get more views, because that's not my interest. If I could get a handful of really exceptional traders, okay, that are consistently delivering the results that they aim for, that's my goal. I don't monetize my videos. I'm not trying to get hits or stats. So it's really the feedback, okay, that I get a high off of. So it's with really that I'm hoping that if this video series has been helpful to you, if it's insightful to you, to help you build a foundation to price action analysis, I would love to have some feedback. You can reach me at ICT at theinnercircletrader.com. It's really the driving force behind why I do what I do, because I do not sell courses, I do not sell seminars, I do not sell books, I do not sell any information whatsoever. I do this because of just the sheer passion in sharing it. Um, I'm successful in my own right, so by sharing it, it's certainly not going to take anything from me. But I certainly do enjoy and really get invigorated by the feedback of new developing traders or folks that have been trading for a long period of time that come on to the ICT concepts, and it really gives a supercharge to their understanding and price action, and hopefully the results are positive. So let's get on to this presentation. Okay, so what is it we're going to be looking at in this presentation? What are we going to be covering? Well, we're going to be reviewing the series, okay, and basically going over what it is specifically that you as the viewer, okay, should have gleaned. Now we're going to be looking specifically at the ICT Sniper Series skill set. We have to understand that, going through this video series, we've learned that the market moves only by means of large funds entering and exiting. Price seeks yield. So where yields are and where yields are moving towards, that is going to be a catalyst for where future price action will ensue. Okay, so you have to understand that price in itself isn't just simply moving around, aimlessly. There is a driving force fundamentally, okay, driving force behind price action. We cannot always discern what that is. Okay, there are fundamental traders that, uh, admittedly, they may be very, very astute in terms of the fundamentals, but me as a trader, I simply can't grasp fundamentals as a central tenet to my trading. So I rely on price action to convey those that are smarter than me in that realm, okay, because large funds and banks are more in tune with the fundamentals and the drivers behind currency exchange. I allow them to, pretty much leave their footprint in the sand. And then if they're doing something specific, I'm going to be looking to follow suit. Okay, so it removes all of the necessity of being a genius. Now we do not look to predict price moves. Okay, we would rather wait for smart money to move price initially. Now this is going to help you hone the skill of patience. And if you understand what that footprint looks like, and we talked about that in several examples in the series, it allows you to simply wait for that, if you will, road sign. Okay, because most individuals sit in front of the charts and they really have no idea what it is they're specifically looking for. But hopefully with this series, we have zeroed in on what specifically you're looking for. That initial move, that quick, sudden move away from a particular price level, that indicates fundamental flows being driven by institutional level trading. Okay, retail trading cannot move the market. We are just little fleas on the big dogs. Okay, so if the dog's running, okay, hopefully we're on for the ride. The bottom line is we can just take a little bite here and there, but ultimately we can't make the waves. We just ride them. Now the typical business model in trading is simply understanding that there's a generic price action theory that unfolds on a daily basis that goes over and over and over again between London to New York and London close. Okay, there's a small little pocket of action that goes on in Asia, but we didn't spend any time of any significance really in that. But I do have a video dealing specifically with Asian trading, so if you look at that on my YouTube channel, you can certainly glean what it is that's useful for that time window or kill zone. But specifically, moves repeat in specific times of day and specific days of the week. And that phenomenon, again, is very generic. It's not attributed to any one author. It's not attributed to any one specific, source. It's just a generic observation that I've made over the years, and gleaning certain things from Larry Williams, trading day of the week, understanding with his bond and S&P trading, really gave me the insight to, hey, look, you know what, he's right, because he mentioned in his teachings that, humans by far and large we're really good starters, okay, but we really suck really at finishing, okay, and we spend a lot of time throughout the week, okay, trying to chase money. But as we get closer to Friday when the markets are closing, our interest really wanes, and we anticipate the weekend. So we spend the most time of our weekend studying, looking at fundamental data, price charts, and we're all in a hurry to get ready to do something new for the new week. And that's why typically the weekly higher low is formed in the first couple days of the week, and then the weekly range unfolds with that in mind. So we learned that there's a specific generic business model that takes place, and we understand how market makers deal within that overall price model. Long-term higher time frame charts illustrate the direction of smart money. Now, the smart money, again, we've identified as the large funds, the institutional banks, um, traders that have huge accounts and large supplies of money to really cause these major shifts in price. we as traders, we and on a retail level, we cannot cause these major price spikes. Okay, there's just simply not enough of us. But when we have a higher level entities, okay, that have really deep pockets, when they do exchange transactions in the marketplace, they can't hide that. Okay, so there's a very, very telling footprint, okay, left in the charts. If you understand what it is you're looking for, it really tips the cards and lets you know what it is they're doing. Smart money or large funds are not scalpers. Okay, they require and produce sustained moves. So that was hopefully one of the main paradigm shifts that you encountered with this series, because you're going to need the understanding of waiting for specific price action, okay, to unfold before you take action on your retail account. Because if you're a scalper and you don't understand the concepts of how large funds and order flows directly impact you as a trader, even as a scalper, you will fail. Okay, you have to understanding that price has to move by a larger entity, and without that institutional quote unquote sponsorship that I like to refer to as in price moves, you're simply going to not see the advancements in price that you hope to make even as a scalper. So we did a very in-depth study of smart money and large funds and institutional level order flows. So when you see that type of thing unfolding in your charts, you know that's a green light go. You need to start following that market. Okay. Now, trading in environments where institutional flows move price will, as a direct result, make your equity rise, because you know that the market is predisposed to move on a grand scale, not minor static little short-term blips and just static price action. That's not how you want to be trading, even in any other asset class, not just simply in FX. You have to have that environment where things are moving. Okay, as traders, we need price movement. If price is stagnant, there's a reason for that, and we're going to talk more about that as we go. Quiet markets are quiet for fundamental reasons. Specifically, dead money or street money invariably trade during these times because they need to be doing something, because they have no plan. They're like a dog in a meat market. They're nibbling on this and nibbling on that. We, as specifically detailed oriented traders, okay, very patient, very goal oriented, okay, we are we are trained to look for specific things in the marketplace. We don't simply go in there because we have time to sit in front of the computers to do some trading. We are looking for something specifically in the price charts before we even contemplate putting on a trade. Okay, and that's the divider between the stupid street money, okay, or the neophyte rookie traders that just because they read some website, okay, claiming to give you the introductory course on price and forex, that will not equate to success, because there's a whole lot of other things that have to go on that the majority of teaching and resources on the internet simply do not have the understanding or the the responsible nature in revealing it to you. Okay, so just simply because it's quiet and you think it's safe, and your stop loss will be safe because it hasn't been moving around that much. Think about it as a new trader when you first got involved. Fast markets are scary, right? Why? That's what you want as a trader. Okay, you're in control of the risk. You're in control of the leverage. So a fast market can be tamed with your leverage. Okay, but quiet markets are basically, they're just graveyards waiting for you to to bury yourself in, because you'll overtrade them. Because even if it's a small stop that you think you're safe by implementing, small stops still get tripped if you're wrong. And 90% of the time, new traders have no idea what they're doing, and this static price action alone will come down and tag you out. But you are a new trader. You're going to overtrade a quiet market because you need to get that money back, and the cycle repeats. And we talked about that type of thing in this series. You require, as a professional trader, volatility. And volatility is the telltale sign that someone with more money than you is moving the market. And it's time to start paying attention to that particular asset class. Okay? Price moves typically in an overall weekly direction. okay, and you want to be trading in that direction, whether you're short-term day trading, or if you're looking like what we teach in this series here, one shot, one kill, one weekly setup per week, to build discipline, to build skill set development, and understanding how the institutional and large order flows move the market, and you can sit on your hands and wait for really these cherry setups where you just simply are just not you're not interested in all the little tiny minor moves. You just want something that's really locked for a high probability, low risk opportunity. Dynamic and/or explosive moves result from higher time frame analysis and time and price theory. By coupling the higher time frame analysis concepts and time and price theory, kill zones, trading day of the week premise, you will have the ingredients for a very, very dynamic price action based model of trading. Entering when markets move opposite to your intended trade is optimal. That's the premise behind the ICT optimal trade entry. The OTE forces you to trade in the opposite direction of where you intend to profit from. Okay, you're selling during a rally. You're buying during a decline. That's how that price pattern works. Because you are doing that, you will overcome the dealer spread much more quickly, and you'll be closer to your stop versus waiting for the market to move, looking for what you think is confirmation, but it's moving farther away from where your intended stop loss placement should be, thereby requiring you to take on more risk, okay, than necessary. So we've learned that with a paradigm shift, looking at how the markets are ideally and optimally traded when it's moving away from your intended trade direction. And it takes some skill set exercises that require you to be in the market looking at how price moves on a lower time frame, because it gives you several opportunities, a couple times a day, where you can do these types of skill set exercises and see what it's like when you be buying and it's a bearish candle. Okay, when it's a bold-faced bearish candle, it takes some reverse thinking, okay, because it looks like it's going to continue to go lower, and that's exactly what the myopic retail traders think, and those that continuously lose their shirt. You have learned how to think differently. Your mindset has now been plugged into how smart money operates, because they have to buy when prices go down and they sell when prices are going up. Market makers generally price markets higher to sell into the rally. We understand that that's the market maker sell model. By having that template in mind, we can understand that when price rallies, okay, and goes into a resistance level, the price model, okay, generically speaking, if you will generally unfold as that graphic that I shared in the series, okay, depicts. Okay, and the same thing is said for a market maker buy model. Market makers will generally price markets lower to buy into that drop. So it goes back to the fundamental premise that we don't chase price. Okay, we understand where price may be trying to get to, and when it gets to specific price levels, then and only is when we stalk setups and price patterns to facilitate or execute a trade entry. We don't care if prices explosively moved 150 pips and our setup has moved, okay, outside the parameters of a potential entry, and price takes off and goes and leaves us behind. We do not care about that, because we understand that the premise that we use to trading repeats over and over and over again. We don't have to force ourselves into a trade, and we don't have to chase it and jump on board after it's done moved 40 pips. There's no need for that. Okay, and hopefully this series has produced that mindset in you, because if you're chasing price, you're looking to throw your account away very, very quickly. Now, significant price moves are typically seen immediately after stops are rated. Now, we've given you exercises to look for where clean levels are on your chart. If you see several times where short-term highs have made rallies up to a specific price level, but neither one made of any significant sweep above the previous high, that is an indication that the level's too clean, and folks that are trading that market, they may sell into those highs, okay, and their stop loss orders would be just above those particular highs. when you see that phenomenon, and same thing is said for equal lows, okay, or double bottom lows. I don't like double bottoms because to me they're just classic scenarios for folks to put their stops beneath it, and then what'll happen is you'll get a turtle soup, okay, or a similar pattern like that where it will variably go down, spike through it, rate it, and then very dramatically and dynamically run the other way. Okay, and when you see that happen, if you don't take action during the raid itself, okay, if you're not astute enough to know how to trade those raids, then you can simply wait for them to unfold and then wait for the order block to be retested after that initial move up, because it's going to be the same thing that we look as a classic price rally. We wait for the pullback and then we buy into it. And same thing said for a selling scenario. Now Fibonacci can be used in trade execution, and we use it for stop placement and target setting. Okay, and using the skill set exercises that we released in this series, there's nothing outside of that that I do with Fibonacci that is necessity or necessary rather that you need to do with Fibonacci to make it any more complicated than it is. You're looking to find a pullback between the 69 and 79% retracement levels, and hopefully that is an overlay of an order block within a higher time frame directional premise, and it's simply that you just wait for that to unfold, and you use your swing projections and your market structure to define highs and lows that you would look for extensions in your Fibonacci for price objectives. Okay. Now, London Open and New York Open are ideal day trade sessions with unique trades. Typically, we learned that the London Open has specific characteristics that's inherently directly related to the higher low of the daily range, and the New York Open typically has a specific characteristic that is in relationship to what takes place during the London Open. And by specifically trading those time windows or ICT kill zones, you have the highest probability to trade when specific market turning points take place. Now, the majority of the daily range highs and or lows form in specific time windows, or what I commonly refer to as ICT kill zones. It's not enough simply because you have the free time to sit in front of the charts that you expect the price to move. You have to be on board and plugged in when the players are on the playing field. If the banks are not looking to do anything transactionally, the markets are not going to be moving. And we've identified where they generally like to cluster in terms of volatility. We see a volatility injection in London Open, a volatility injection during the New York Open, and a volatility injection at the London close, and very, very minor little movements in Asia. Okay, and we look for weekly setups that align with higher time frame, time and price at key support resistance levels. So we understand how to look at higher time frame support resistance. We understand how to break down directional bias on the higher time frame daily and 4-hour. We understand how to look at specific times of the day and specific days of the week. We understand by blending all those things, that's what facilitates or defines a high probability, low risk trade. Lastly, trade with controlled risk management and equity management always. It's not enough by having sound principle oriented trading concepts. It's not enough. If you over leverage or if you over trade, you will blow your account. Okay, so it's important that you work within a demo account setting until you're absolutely 100% confident with your ability to stick to within a realm of rules and discipline oriented trading. Only then, when you decide, I can't define it for you, I'm not suggesting that you should start trading live money until you yourself have assumed the responsibility, you've assumed the understanding that's necessary for you as a trader, emotionally and psychologically, before you place a single penny at risk in the marketplace. You need to define yourself as a trader, what specifically you're going to be doing. Okay, and then when you understand that, even then, still keep your risk exposure very, very low. Okay, what analysis and process is used to study the daily chart? Okay, we're going to be looking at the macro view on large funds and order flows. Now the ICT daily chart time frame checklist. Now this is what you're doing, okay, when you first sit down at your chart and you first begin your analysis on a particular pair or asset class, if you will. You have your daily chart opened up, okay? What is it that you're supposed to be doing? Well, our concepts that we shared in this video series, okay, teach us that the very first thing is that we look to see where yields are, okay? Because the market seeks yield, and where yields are supplied, there too is where price will draw to, okay? And we understand that the 10-year German and the 10-year USD bond yields are useful. You can look at the European, UK rather, 10-year bond yield as well. And when you start seeing these that divergence as we discussed, okay, that's usually a telling sign that we're going to be seeing a shift. But if you are familiar with the futures market, you could look at the 10-year T-note, okay, and whatever the T-note price is doing, just that's going to be the opposite of what yields are doing. So if T-notes are going up, yields are going down, and if T-notes are going down in the futures price, that means yields are going up, okay. And yields that go up will generally, on a higher time frame basis, will generally pull price up in the currency market, okay. So it's always chasing yield. The yield itself is the directional premise. You follow where the yield is, okay. Or if you want to use the futures market, it's going to be the opposite of what the T-notes are doing, okay. Now, seasonal tendencies are something that I consider, but they are not a panacea. They're not a be-all, end-all, and they're no guarantee. Now, I use them as I suggested in this video series. They're more like a roadmap. And if I was to ask you, in the States, we have, pretty routine seasonal influences. We understand when the snow is most likely to occur, what months of the year. We understand when it's going to be hot. We understand when it's going to be cool. We understand when there's going to be allergy season. Okay, seasonal tendencies are valuable because we can look at when the large significant price moves are most likely to occur, specifically during certain months of the year. I would counsel you to utilize the seasonal tendency in that capacity first until you grow in your understanding of how the seasonal tendency chart really communicates what's going on. It's not simply looking at the lowest low on the seasonal tendency chart and say, okay, well, the market makes a low on this chart between this month and that month, so therefore I'm only going to be looking to be buying then. No, you have to have some other technical characteristics behind the idea, not just simply doing it because a seasonal tendency suggests that it's going to make a low or high. Okay, we're really more inclined to following when there's a large price swing that usually moves in one direction or the other. That's really the basis for how I use seasonal tendencies. Okay, we look on a daily chart for obvious key support and resistance levels. Now we note these with at least 2 to 3 years of data on our screen. Okay, by having that amount of data on your chart, it really will remove the necessity of having your weekly chart analysis done. Okay, but it will at least give you the higher level support and resistance levels that may be outside the scope of most myopic neophyte traders that simply don't look beyond the last couple weeks. Okay, now do not discount the levels acquired on the study of weekly and monthly charts, okay, because these two are odds builders. They have the impact, okay, of creating very, very dynamic reversals, okay, and if you ignore them, okay, you're really handicapping yourself. So while I didn't spend a whole lot of time in this series doing that, it would be very foolish of me not to at least include it as a suggestion that you should be looking at the monthly and weekly charts periodically, not a whole lot, just once in a while. Just take a gander at it, and you'll hopefully see you're within a range that facilitates sound trading with the daily chart and lower time frames in mind. Okay, on the daily chart, we try to determine the current market structure. Okay, are we in a bullish market structure or a bearish market structure? Have we just encountered a market structure shift? Okay, has a specific key high been taken out? So now we would be looking for a buy model to unfold, or is a swing low of any importance unfolded, where we now look for bearish markets moves and sell model to unfold. Okay, and what price swing are we trading in? Is it a long-term price swing? Is it an intermediate-term swing? Or is it a short-term swing? Okay, these are things that you have to discern that'll really build upon the type of trade that you're going to be hunting. What are large funds doing, and where is the order flow suggesting prices trading up or down? Basically, it's like market structure or order flow, where if we take out specific highs and lows, again, in conjunction with market structure as a whole, if we see flows are bullish, okay, we need to be starting to look for our tools to suggest and support the notion that higher prices are in order, and vice versa for selling scenarios. Overlaying the 9 exponential moving average and 18 exponential moving average, okay, for the buy and sell models is very useful for directional bias. It's one of the reoccurring themes I get in email all the time. How do I know if the market's going to go up? How do I know if it's going to go down? Well, first I'll tell you now, like I tell everybody in an email, I don't know for certain it's always going to be up or down. I just have a odds of knowing over a period of time I'm more often right than I'm wrong in terms of directional premise. And that's all you need in trading. But to mathematically define how you as a neophyte trader can classically determine a bullish or bearish market, okay, just by looking at the 9 and 18 will give you a very, very good tool for looking for weekly setups. When the 9 exponential moving average is greater than the exponential moving average, that means the 9 is above the 18, we look to focus simply on taking long trades. Okay, we're only trying to buy that market. When the 9 exponential moving average is less than the 18 exponential moving average, or in other words, the 9 is below the 18, we focus on shorts only. Okay, we highlight key swing lows and swing highs. Now, by having that, we have to note the high, the low, the open, the close on each of the 3 bars that comprise a swing high and swing low, because those specific levels are going to be very, very sensitive. Now, if you spend a lot of time looking at price charts, okay, on a daily chart, do some exercises, okay, to further build your understanding of how the high, low, open, and close prices are sensitive. Because when price goes back to those levels eventually at a later time, you'll see many times that that's exactly where price patterns will form, and they'll happen to occur during an ICT kill zone. Identify major reaction levels where price obviously and strongly moves away from a particular level. Okay, that's the footprint we're looking for. When we see that, we know we have institutional sponsorship. So when we have the first pullback, that's what we buy. Or if it's a decline, the first rally up, okay, that's when we look to sell into. Highlight potential order blocks where price will possibly react in similar fashion. Now, I'm not going to revisit order blocks because I did it exhaustively in this series. So if you understand that concept of how I determine where institutional order blocks are, you'll know what I mean by this, okay? And I'm going to take a moment here to amplify what we're doing, because this may look like an oversimplification so far in this video, but I really want you to understand there was a whole lot of information delivered to you over 7 individual videos. I'm not going to build up each piece of this with examples, because you already have that understanding in the video itself. So you have to take that information and build it upon this checklist, okay, and amplify your understanding what's necessary. Now all levels and order blocks are carried over to the lower 4-hour and 60-minute and lesser time frames. Okay, what analysis and process is used on the study of the 4-hour chart? Now the intermediate view on large funds and order flows. It's the ICT 4-hour chart time frame checklist. Okay, now the daily analysis is kept in focus here. Okay, simply because we're down on a 4-hour chart does not mean we simply toss away the analysis and the premise that's arrived at looking at the daily chart. Now we hold on to this bias, okay, derived on the daily chart as our foundational basis for trade ideas. While the daily analysis is in a buy model, we look for key support levels to stalk setups on. And conversely, while the daily analysis is in a sell mode, we look for key resistance levels to stalk setups on. Majority of stop orders are discernible on this time frame. Look for rating candidates because they're going to provide you liquidity, and where there's liquidity pools, there's going to be very discernible clear highs and lows that if taken out, it would still keep the overall price structure either bullish or bearish. But you got to ask yourself always, where's the guys that are profiting right now? Where are they placing their stop loss order? Because before the next significant price move happens, invariably that level's rated and tested, and then quickly seeing price reject and go the other way. Define 4-hour order flow and couple this with market structure. What do I mean by that? Okay, well, we look at the 4-hour trend. Okay, we look at key highs and lows. If a specific short-term high is taken out on a 4-hour chart, once that's taken out, our order flow and market flow has changed to bullish. Okay, and we're going to be looking for that to be in alignment with the higher time frame daily. Ideally, the same thing would be seen on the daily chart. In other words, if we have a short-term high taken out on the daily chart, order flow is now bullish. So if we're looking at the 4-hour time frame, when the 4-hour market flow and or order flow changes to bullishness, we have both in agreement. Okay, that's simply not enough. You have to have that coupled with market structure. Are we having entering a term, a long term or short term low or high forming, and where are we at in terms of price swings? Okay, by blending all those components together, okay, you'll find that you're buying at support when the daily trend or bias is up. And conversely, the same thing could be said in reverse when a 4-hour order flow is coupled with the market structure. Okay, you're going to be selling resistance when the daily is down. Look for reaction levels within the daily directional premise or bias. That means your 4-hour chart's going to see quick sudden rallies or declines. Okay, ideally those moves will be in the same direction that you have arrived at for a bias on your daily chart. If it's not, you don't trade it. That's not your trade. Okay, so we're filtering out a specific side of the marketplace that we want to be executing our trades on. Yes, you're going to miss trades. I'm promising you that you're going to miss trades. I'm promising you that you're going to miss explosive dynamic moves that are counter trend. Who cares? You want to be consistently taking one solid setup per week, profiting, moving to the sidelines, and waiting for the next setup. Order blocks can be fine-tuned on this period and more precise levels at or near institutional levels. So in other words, by taking your 80s, your 20s, your 50s, and your full figures, those levels will be very close, if not many times, the precision levels that you will see these formations and price patterns take place. If in doubt on the daily chart, the 4-hour chart can be used as the guiding light on directional bias. All 4-hour analysis is carried out and over to the 60-minute chart and or lower time frames. Okay, what analysis and process is used on the study of the 60-minute chart? Now this is the short-term view on large funds and or order flows. The ICT 60-minute chart time frame checklist is as follows. The daily analysis is still kept in focus here, and again we are still holding on to this as our basis and foundational basis for trade ideas. The daily analysis could be mixed, so consult the 4-hour perspective if that's the case. Ideally, daily and 4 hours should agree. The order blocks on both daily and 4-hour will produce the highest probability setups, so it's important that you focus there first. The reaction levels seen on the 60-minute chart will permit fine-tune entry with the utilization of order blocks, and those order blocks will be selected based on the same premise that you find on the 4-hour and daily. a sudden quick advancement in price or a decline in price, then a return to the point of origin. Viewing the weekly perspective on a 60-minute basis will provide a good vantage point for swings. Now, when you're looking at a weekly section of price action, okay, it's very easily studied with a 60-minute time frame. If not a 60-minute, a 15-minute is good as any. But for now, sticking to the 3 hour time frame, if you look at your weekly basis, overall perspective rather, on price action, in other words, looking at 2 to 3 weeks worth of data on a 1 hour chart is ideal. It gives you a good vantage point for understanding where prices are swinging and retracing back into that way you can find what range you're trading within. Look for logical levels where retail traders and funds would possibly have their stops resting near. Again, looking for possible liquidity pools before the next significant price advancement or decline. Use market structure concepts and fibs to stalk possible confluences where setups will form. Again, you're down to your lower of the 3 higher time frame perspectives. By utilizing your fibs on this particular price chart will give you very dynamic risk to reward ratios. Okay, your risk will be very low. Many times, ideally, you want to be hunting 1 to 3 risk to reward. Okay, so in other words, you're going to be hoping to make it as much as 3 times what you're risking. The day of the week theory is a rough idea where the weekly high or low is likely to form. So by implementing that idea with studying the 60-minute chart with a 2 to 3 week vantage point in terms of how much data you have on your chart, that'll give you a very good basis to work within. If we are bullish and hunting a weekly long setup, typically Monday to Wednesday, typically the weekly low is established. If we are bearish and hunting a weekly short setup, Monday to Wednesday, typically the weekly high is established. We are not looking to trade every day. We're looking for one solid setup per week consistently. That should be your goal. You can trade intraday, day trades, in the same directional premise that we've arrived at on the daily and 4 hour. Do not use the 60-minute without at least referring to the 4 hour, and ideally with the daily as well. Okay, but if you are a day trader and you're using this course of understanding and price action as your beginning point or foundational study, and you simply want to be a day trader and aren't limiting yourself to just taking one setup per week, if you're trading in the directional premise that's arrived at by using these concepts, you can still do day trading, but still focusing on that one side of the marketplace, either being a buyer or seller based on daily and 4 hour. All daily and 4 hour and 60-minute analysis is carried over to the 15 and or 5-minute time frames. Okay, what analysis and process is used to study of the 15 and 5-minute chart? Okay, this is the execution view on large funds and or order flows, and the ICT 15 or 5-minute chart time frame checklist. The daily 4 hour and 60-minute perspective is maintained even while studying price action on the lower time frame 15 or 5-minute charts. Have the days separated with vertical lines to highlight possible day of the week theory. Again, if you're looking for the weekly high or low to form, it's going to generally happen between Monday, Tuesday, or Wednesday. And there's more detail as to when it's more specifically expected to happen in the video series if you go through the material. But for now, we can generalize it by saying Monday to Wednesday, the weekly high or low is formed. So that way you can trade the rest of the week in that directional bias. Note the Asian range high and low each day. 5 GMT is the end of the Asian range parameter. So what happens after 5 GMT, which is essentially 12 midnight New York time, my time, that's where I classify the new day. Now, one could argue, again, like I mentioned in the video course, that the new day starts in Wellington, and I'll leave that up to you to decide. But for now, if you want to look at the market the way I'm looking at the market, I consider midnight the new day, and what happens after that price point is many times many more valuable in terms of what takes place prior to that. Look for the daily highs to form in sell models between 7 GMT and 10 GMT. This is typically the London session. London invariably has a high probable likelihood, if you will, of forming the daily candles high or low. Okay, and if we formulated the trading bias to be bearish, okay, we could be hunting the daily candles high to form between a specific time window, and generally that's 7 GMT to 10 GMT, or the London session. And conversely, if you look at the daily lows, you could find them forming in buy models between 7 GMT and 10 GMT. Now typically the daily high or low is formed on a sharp counter trend direction on that day. In other words, it's the Judas swing. It's a false move initially to fake everyone out, and then quickly rejects and goes the other way. Okay, we stalk the setups by combining time and price theory. We hunt inside time windows and within large order blocks found on the 60-minute, 4-hour, and daily time frames. Opposite daily high or low is formed inside the 15 GMT to 16 GMT hours, London close. What do I mean by that? That means that if the high is formed in London, the low on the candle for that day is generally made during the 1500 GMT to 1600 GMT. If the reverse is made in London, okay, the opposite spectrum of the daily candle range high or low is formed obviously during London close. So I guess one could easily say it that the higher low is formed in London open, and during London close the higher low is formed conversely. When time and price theory overlap, trading patterns will form, and that could be in the form of an optimal trade entry, harmonic trading patterns, and even simple divergence. Okay, so having this understanding will facilitate a whole nother level of trading for you, and that way you can identify very, very high probability, low risk trade scenarios where price action alone, as the catalyst, is already predisposed to move in that direction. Use fibs and swing projections to determine possible price objectives to form risk to reward ratios. Use fibs to fine-tune entry points inside order blocks with London and New York ICT kill zones. If the London setup is missed or you were incorrect and stopped out, you can use 12 GMT to 14 GMT the New York Open session. Now, most of the time, New York Open is a continuation setup on the heels of what London's action already placed in. So in other words, if London posted the daily high and it's been going lower, many times the New York Open session will be a retracement within the range formed for the daily candle at that point from the high made in London to now continuation going into the London close, completing the daily candles price action. Now you want to avoid the New York Open setups if daily swings are maturing into key support resistance. New York Open could produce reversals. All trades should be limited to 1% risk of total account balance. Ideally, while learning, 0.25, in other words, 1/4 of 1% to 1/2 of 1% risk should be the beginning trader's parameters for maximum risk exposure. And as you get more consistent, obviously you can move towards 1% risk. But I would certainly advise you not to go above 2%, even though it's commonly driven down our throats that 2% is the industry standard. Most professionals do not trade with 2%. If a loss is taken, reduce risk and leverage in half until the loss is recouped. It's slow and steady. That's what wins the race. Okay, so even though one could argue it's going to take you longer to recoup the loss if you have less risk exposure. But I'm going to counsel you to go back to how we are looking at trades. If we're looking for trades that have 3-to-1 payout, in other words, we're making as many times 3 or more times what we risk, it doesn't take very long to recoup the loss. Okay, so theoretically, one could argue the thought process of that it's going to take you longer, that doesn't hold water. Okay, and if you put these concepts to task, you'll see what I mean. It's so much more understood, obviously, by applying it and seeing it in action, even in a demo account setting, which is what I advise you to do anyway. Do not rush the patterns. Wait for the setups and the time of day for the highest possible odds. Do not feel rushed. You don't need to rush. Simply because you have time to be sitting in front of computers does not equate to profitable trading. So it's really important that I hammer that in your head. Focus on 60-minute reaction levels for ideal risk to reward ratios. Again, many times 1 to 3 or better. In other words, you want at least 3 times what you hope to absorb as a, not hope to, but if you're willing to take a loss, in other words, if you take a loss of 20 pips, okay, you're looking for ideal trades at least 60 pips or more. Okay, so the setup that you're trading, the parameters that outline that trade idea, the risk is defined to 20 pips. Ideally, you want 60 pips or more in terms of profit potential. Okay, so if you stay in that realm, you'll be very effective in terms of long-term trading. You only need to be about 70% of the time, to be wildly profitable. But if you trade with 3-to-1, you can be far less accurate in terms of your trading and still be profitable. And that's really where you want to start as a trader. If you have no foundation in the daily or 4-hour time frames, you have absolutely zero reason to be at this stage of analysis. Don't even look at a 15-minute time frame. Don't look at a 5-minute chart, because what you're going to do is you're going to talk yourself into a trade that may or may not have its foundation or premise built upon the higher time frame daily and 4-hour and 1-hour charts. Stay patient and stay focused. Results will manifest and absolutely surprise you. Now, hopefully this course has been insightful to you, and it's been crammed with a lot of price action analysis concepts that are unique to me, but there are many in the world of naysayers, okay, that have watched some of my material, or if not all of my material, and walked away thinking, well, he has too many moving parts, okay, and there's too many things for his concepts to be applicable. And again, I'm revisiting that because I want to close with the premise in mind that think about the concept of riding a bike. Okay, when you're a child and you watch someone, maybe it was your older brother or sister riding the bicycle, okay, you aspired to do that very thing. And perhaps that person that you were aspiring to ride like, okay, was able to do a wheelie. In other words, he could ride on his rear wheel. Okay, or when I was growing up, we were like the years of BMX, bicycling, and you know, trick riding, where you could sit on the handlebars and ride backwards on the bike, and that's advanced level riding. Okay, you can't do the things that those types of riders, okay, perform until you get past the training wheels. But before you even get to the training wheels, you got to be able to get on the bike and mount yourself and stay on it before you can even start pedaling. There's stages of development, okay? Now, obviously, if you were to break down each component from the grandest scale of being proficient at riding a bicycle to the minute detail of simply beginning the origin of aspiring to want to ride the bicycle, okay, anything and everything could be made very daunting with a immeasurable level of explanation. But this, in terms of trading and speculation, is so dangerous to a trader with no real understanding. It's important that you have as much understanding, general knowledge, before you put your money at risk. Okay, and I think if you studied this information and you had traded prior to understanding these things, you would feel a little foolish on your part that, you know, you're probably questioning why you were trading before you understood these types of things. And that's good that you identify that. But my main point here is, while it takes a large amount of time and effort on my part and yours to discern the general approach and concept and core tenets to how I view an analysis, the overall summary of these things, okay, are very condensed. And even this summary here, once you understand specifically what it is that's expected of you as a trader, you could take this entire summary and place it in a form of simple text that will fit on a business card. Okay, you basically, this is a summarized view of what it is that you should have gleaned from this course. But ultimately, it's this: if the daily chart suggests it's going to go up, and the 4-hour is in agreement that it's going to go up, use the 1-hour chart to set up a time frame setup that allows at least 3-to-1 risk to reward. Okay, so to summarize, that would be simply this: look at an hourly chart, buy when the daily and 4-hour suggest it's likely to go higher. Use your fibs to pull an optimal trade entry pattern where it overlaps with an order block. Use a previous high as your first objective to exit with profit, and then use Fibonacci extensions to take your additional profits. Look to be buying on a Monday, Tuesday, or Wednesday when it's bullish. Okay, and the reverse is said for sells. You time your entries during London and New York. Risk only 1% or 1/4% or 1/2% based on your understanding. So in other words, it's either, if you're brand new at this, it's 1/4 of 1%. Even in a demo account. Don't think just because it's not real money, you're not going to, learn anything. You're going to learn a whole lot, or as much as 1/2 of 1%, but certainly no more than 1%, because it's important that you develop the idea of growing your money steadily but not exponentially quick. Okay, that can come at a later time when you understand a lot more about yourself as a trader, not in the beginning. Okay, so simply having the understanding of all the things that we've talked about in here, okay, and incorporating that into a process, by doing that systematically over and over and over again, it will become ingrained in your memory. It'll be a process of simply just doing it and not thinking about it. But collectively, if you understand everything that was talked about and conceptually broken down, the understanding of actually doing those very things, the procedure, can be really condensed to a business card amount of space in terms of identifying it. But if you were to take that business card and hand it to someone that has no understanding or general understanding of how the markets operate, that business card is the same thing I said when I initially came out on Baby Pips and said that I could put this information on the front of USA Today and it would go largely ignored because it would go right over everyone's head. So that's why I forced you, number one, with 6 months of study time. I forced you to have exercises modularly. And now with this, even though if someone's just looking at this video module, they're thinking, this is ridiculous, this is useless. That's precisely my point. You got to go back through the videos, take those pieces of information that arrive at this summary, and when you formulate it in this form here, when you understand each component, you have absolutely the ICT $1 million trading plan. And with that, guys, I wish you good luck and good trading.